let's now try to understand a very important tool used by management accountants for profit planning, a tool known as cost volume profit analysis or CVP analysis. This analysis studies the relationship of cost, volume and profit. The three factors cost, volume and profit are always interrelated. How so? The cost of a product determines its selling price. The selling price in turn determines the volume of sales or the number of units that can be sold by a company. It also affects the volume of production and the profit earned by the firm. So, variations in volume of production affect both cost and profit of the firm. CVP analysis therefore helps us understand how costs and profits vary in relation to changes in volume of production. Hence, it is an important tool for managerial decision making and profit planning. CVP analysis can be used to assess the following factors. First, behavior of cost in relation to volume. How does the cost change with respect to change in the number of units manufactured or produced? Volume of production or sales where the business will break even. Sensitivity of profits due to variation in output. How does the total profit earned by a firm vary when this variation in the number of units sold? Amount of profit for a projected sales volume. Quantity of production and sales for a target profit level. We will now try to understand each of these factors in greater detail. Let us start with one example. We have to find the contribution and profit earned if the selling price per unit is Rs 25, variable cost per unit is Rs 20 and fixed cost is 3,05,000 for an output of 80,000 units. We know that contribution per unit is the difference between selling price per unit and variable cost per unit, that is 25 rupees minus 20 rupees or 5 rupees per unit. The problem states that the volume of production or output is 80,000 units. Therefore, total contribution earned by the company is 5 rupees multiplied by 80,000 units or 4 lakh rupees. We also know that profit is the difference between total contribution and fixed cost, which is 4 lakh rupees minus 3,05,000 or 95,000 rupees. Hence, contribution and profit earned are 4 lakhs and 95,000 rupees respectively. Moving on to the next concept or profit volume or PV ratio. This is also known as contribution by sales or CS ratio. This ratio establishes the relationship between contribution and sales. Any increase in contribution will lead to higher profits as fixed costs are assumed to be constant for all levels of production. That is, fixed costs have to be incurred even if the company does not produce a single unit. So, the profitability of products can be analyzed by reviewing the CS ratios of the products that the company sells. There are several formulas that can be used to calculate CS ratio. The first formula is total contribution divided by sales into 100. Now, we know that contribution is equal to sales minus variable cost. So, the next formula is total sales minus variable cost divided by total sales multiplied by 100. We know that contribution is also equal to fixed cost plus profit. So, fixed cost plus profit divided by sales into 100 is another formula to calculate CS ratio. We can also calculate CS ratio by using per unit data. So, contribution per unit divided by selling price per unit into 100 is the fourth formula. Last formula is change in profits by change in sales into 100. So, which formula are you supposed to use when you have to calculate the CS ratio? Well, the answer depends on the information that is given in the problem. Depending on the information given, you will have to figure out which of these formulas you will need to apply to get the answer. If all relevant information is given, then you can use any formula to calculate the CS ratio. Remember, a higher CS ratio indicates higher profitability or better profitability for the firm. So, how can companies increase CS ratio, thereby increasing their profitability? Well, they can do one or more of the following. They can increase the selling price of the product, try to reduce the variable cost that they incur on the product, reduce direct and variable cost by more efficiently utilizing labor, machines and materials. They can also switch the production to more profitable products, showing a higher CS ratio. Let's now try to calculate CS ratio if the marginal cost incurred by a company is 24,000 rupees and sales is 60,000 rupees. Now we know that marginal cost is the same as variable cost. So total variable cost of the firm is 24,000 rupees while its sales is 60,000. Therefore the contribution of the firm has to be 60,000 rupees minus 24,000, which is 36,000 rupees. We know the formula for CS ratio is total contribution divided by total sales into 100. Plugging the numbers into the formula, we get CS ratio as 60%, that is 36,000 divided by 60,000 into 100. The way to interpret the CS ratio is, for every 100 rupees of sales made by the company, the company is able to generate a contribution of 60 rupees. The next topic is break-even analysis. It's a widely used technique to study CVP relationship, that is the relationship between cost, volume and profit. This analysis shows the relationship between cost and profits with sales volume, meaning how would changes in total sales impact the cost incurred and the profit earned by the firm. This analysis shows the minimum sales that a firm must make in order to completely recover its fixed cost or sales volume. The sales volume at which sales is exactly equal to the cost incurred is known as break-even point. At break-even point, the firm makes no profit or loss. So break-even point can be calculated either in terms of number of units to be sold or in terms of rupees. So the formula for calculating break-even point in units is fixed expenses divided by contribution per unit. Formula for calculating break-even in terms of rupees is fixed expenses divided by CS ratio. The break-even chart that you see on your screen is a graphical representation of the break-even point. As you can see on the graph, when sales is equal to 1,20,000, the cost incurred by the firm is also 1,20,000. So this is the break-even point for the firm. Any sales less than 1,20,000 will lead to loss, while any sales in excess of 1,20,000 will fetch a profit to the firm. One more application of CVP analysis is the calculation of level of sales required to achieve a certain level of profit. This is known as target profit. So the formula for calculating target profit is fixed expenses plus desired or target profit divided by contribution per unit is equal to number of units to be sold. Let's now look at an example for applying target profit formula. We are given the following information. Fixed expenses incurred by the firm is 1,50,000 rupees. Selling price per unit is 15 rupees. Variable cost per unit is 10 rupees. Profits to be earned is 87,500. The firm wants to earn a profit of 87,500. So that is the target profit. We have to now calculate the sales, that is the number of units and in terms of rupees, that will enable the firm to reach this target profit of 87,500. The formula for calculating sales volume when target profit is known is fixed expenses plus the target profit divided by contribution per unit. Fixed expenses are 1,50,000 rupees. The target profit desired by the firm is 87,500. Contribution per unit is selling price per unit minus variable cost per unit. That is 15 rupees minus 10 rupees. So contribution per unit is 5 rupees. Plugging these values into the formula, we get sales in terms of number of units as 47,500 units. We know the selling price per unit is 15. So the total sales is 47,500 units multiplied by 15, which is 7,12,500. So, if the firm desires to earn a target profit of 87,500, it must have sales of 7,12,500, that is 47,500 units. Let us now look at the last concept in this module, margin of safety. Margin of safety is the difference between sales and the sales required for break-even. At break-even point, margin of safety will be 0 because actual sales would be exactly equal to break-even sales. So, margin of safety is the excess of actual production over the production required to break-even. If margin of safety is high, that means the firm is financially sound. On the other hand, if the margin of safety is low or minimal, the firm has a bigger risk of incurring losses should the sales start dropping. Margin of safety can be expressed in terms of units, rupees, or as a percentage of sales. Margin of safety is equal to projected sales minus break-even sales. It can also be expressed in terms of percentage. So, formula for calculating margin of safety in terms of percentage is projected sales minus break-even sales divided by projected sales into 100. Let us now try to calculate break-even point and margin of safety for the data given on your screen. Actual sales is 50,000 units per annum. Selling price is 6 rupees per unit. Prime cost, which is direct material cost, direct labor cost plus direct expenses, is 3 rupees per unit. Variable overheads incurred by the firm is 1 rupee per unit. Fixed costs are 75,000 rupees per annum. We know formula for calculating break-even point is fixed cost divided by contribution per unit. We know fixed cost is 75,000 rupees. Contribution per unit is selling price per unit minus variable cost, that is 6 rupees minus 4 rupees. So, contribution per unit works out to be 2 rupees per unit. Break-even point therefore is 75,000 divided by 2 rupees or 37,500 units. Let us now try to convert this into rupees. How do we do that? We just have to multiply the break-even point in terms of units into selling price. So, that is 37,500 units multiplied by 6 rupees per unit. So, break-even sales is 2,25,000 rupees. The next step is to calculate margin of safety. Formula for this is actual sales minus break-even sales. Actual sales is 3 lakhs, that is 50,000 units multiplied by 6 rupees, and break-even sales is 2,25,000, which we have just calculated. So, the difference between these two amounts is 75,000 rupees. So, we can conclude that as long as the firm sells more than 37,500 units, it will earn a profit. If the sales start dropping from the current level, as long as the drop in sales is less than 75,000 rupees, the firm will continue to make a profit.